Okay, welcome to the Understanding How Risk to Reward and Strike Rate Interact lesson. Now, this is basically going to teach you everything you need to know about risk reward and how strike rate and risk reward create positive expectancy in your trading and can grow your account. So this is the only lesson you're ever going to need to know about how to make money in the markets. It's a very, very simple maths equation at the end of the day. So it's all about finding a strategy that has a strike rate and a risk reward ratio that will generate a positive outcome. So by the end of this lesson, as you can see on the screen here, what you will know is how to define risk to reward ratios and calculate those. Understand the inverse relationship between win rate and risk reward and basically how those two work together. You'll be able to use the risk reward calculator on the website, which is over here. And there's also a link to it down the bottom here. So if you click on that, that will open up the risk reward calculator. We're going to look at how to recognize why higher risk reward ratios require much lower win rates. So if you have a strategy which doesn't actually win very often, it doesn't mean it's not profitable. It means it just needs a slightly higher risk reward ratio to generate that profit for you. We're going to look at how to calculate the minimum required win rate for any given risk reward ratio. So whenever you see any strategy on YouTube or a PDF file you find, or someone tells you about this amazing strategy that's got this brilliant strike rate, you'll be able to calculate and understand whether or not that strategy is going to be profitable long term. We're going to understand the impact of position sizing and drawdowns on account growth. So we'll be able to see an equity curve play out and understand that you are going to have losing streaks so that you're mentally prepared to take those on. We're going to understand how losing runs appear at random distributions as well. So we can run a simulation multiple times to see how the drawdown actually happens on the account based on different trading conditions. You're never going to get the same sort of run of winning and losing trades again and again and again. If you take 100 trades twice, you're going to get a completely different win and loss ratio as you go through those trades. So that's what we're going to cover in this video, and that's what you're going to understand by the end of it. We're going to be doing lots of practical examples within the risk reward calculator here so you can visually see how it all works. So why does this all matter? Basically, the foundation of trading is on mathematics and statistics. So if you have 100 trades and you win 50 of them, but you win more money on the 50 that you win than on the 50 that you lose, you have an edge. And trading is all about discovering and finding edges that will play out long term. Short term, they will not play out. You will have losing days, you will have losing weeks, you will even have losing months with any strategy because of the random distribution of how wins and losses occur with any trading strategy. So it forms the foundation of everything that you do that can become profitable as a trader. It determines also your long-term account survival. As long as you understand the relationship between strike rate and risk reward, you will understand how to keep your capital safe. Capital preservation is rule number one in trading. If you don't have capital, you can't trade. So it's absolutely vital that you protect that capital and make sure that you understand how an amount of risk on your trades is potentially going to affect the long-term equity curve of your account. So we're also going to look at, first of all, the break-even formula. So I just want to demonstrate quickly how the break-even formula works and how the mathematics works with risk reward and with strike rate. It's shown on the screen here, as you can see. So we're going to give you 3 different examples and show you how they work out. So the first one is a 1-to-1 ratio with a 50% win rate, and that will give you a break even. So if we pop over to the calculator here and we give ourselves a 1-to-1 risk reward ratio with a 50% strike rate, you'll see that we start off here and we end here. So it's roughly break even. We're making $49 worth of loss there. Okay. If we run a new simulation with the same risk reward ratio and the same win rate, we will still end up roughly the same. We've got a $49 loss, and we can keep running this as many times as you like. And it doesn't matter how this equity curve appears. It will always end up roughly back at break even. So if you were to run a strategy that had a 1-to-1 risk reward ratio and you won 50% of your trades, think about a coin flip. That is just as good a strategy. You will always end up back where you started. The problem with this type of strategy, obviously, is you're not going to make any money. And by the time you've paid commission spreads and swaps, you'll actually be losing money. So it doesn't work. Okay, so you can run that simulation as many times as you like. And as you'll see, you'll get a completely different equity curve every time you run the simulation, but you will always end up back where you started. It doesn't matter how much you risk. You're still going to end up roughly back where you started. In fact, a lot of the time, you're going to actually lose a little bit more money, obviously. So that is a 1-to-1 ratio with 50% win rate. Now, if we had a 1-to-2 ratio, meaning that every trade we took, we risked £1 to make £2, or risk $1 to make $2, you would need a 33.3% win ratio to come back to break even. So if your strategy wasn't quite as good as another strategy and it lost 2/3 of the time, with a 1-to-2 risk reward ratio, you still won't lose money. So let's program that one in now as well. So move the risk reward up to 1-to-2 and move down to 33%. I can't simulate it exactly because it would be 33.3 risk parameters there. There we go. So put it back to 1% risk. And now we're making $100 a trade. So if I keep running this simulation, you'll see that we always come back to the same point. Big drawdown there, but we got back to the same point in the end. Mixed back to the same point. I'm trying to find one where we get a lovely run up. So it looks like we're making money. There we go. So we had a bit of a dodgy start there. We moved up and made a nice bit of money, but then we had a big losing run. We had 11 trades in a row lose, which brought us back again to break even. So running that 1-to-2 risk reward ratio and the 33% is always going to bring us back to the same point again. A 1-to-3 ratio with 25 is going to do exactly the same thing. So let's say we want to go for much bigger trades. We're going to make more every time we win. If we have a 25% strike rate on those, we are always going to end up back where we started. Okay, so it doesn't matter how good the risk reward ratio is. If the strike rate or the win rate is not enough to make it profitable, you will always end up back where you started. So it just shows you that if you have a strategy which is not very good, but you are always targeting a bigger amount than you are going to lose on every one of your trades, the worst case scenario is you're not going to lose a lot of money. So it's absolutely critical that you keep a positive risk reward ratio on your trades. Let's face it, flipping a coin is going to give you a 50% strike rate. So if we can get a 50% strike rate by flipping a coin and we can make more than 1-to-1.1 risk reward ratio, we're going to end up in a profit. We'll just show you that as an example. If we go to 1-to-1, obviously with a 50%, we're going to come back to break even. We're going to come back to that $50 loss. If we move it up ever so slightly to 1.25, which is the minimum we can do, all of a sudden we're making money. So we're just looking for that tiny little bit more movement in our direction every time a trade works out for us to give us that edge to constantly make money. So you do not have to be the most accurate trader in the world to actually generate profit. So we're going to move over now to some practical demonstrations of how this works. So these you can run yourself as well. So we've put these scenarios basically on the website so that you can run them yourself and understand how this works and come back and remind yourself on a regular basis how risk reward works. It's absolutely critical that you hammer this lesson home because it's the way you're going to make money with any stop loss and TP based strategy. So scenario one we have here is a high win rate, low risk reward strategy. So we're going to use an 80% win rate, a 1-to-1 risk reward, and we're going to risk 1% per trade. So let's go over to the calculator and put that in. So we'll move up to an 80% strike rate with a 1-to-1 risk reward, and we've got our 1% there. So as you can see, we're making $8,000, which is fantastic. So we've got this lovely big equity curve, and because we're winning the vast majority of our trades, we're happy every day because we're making all these wins. We're not losing very often, so we don't get beaten down psychologically. But these types of strategies are incredibly rare and very difficult to find. So the likelihood of you finding a strategy where you can trade 100 trades in this way is very, very unlikely. So the reality is you'll probably be able to achieve that with something like a relative strength index indicator when it gets over the 95 level or below the 5 level, which might happen 3 or 4, 5 times a year. Let's say, for example, it happened 10 times a year. What your actual reward is going to be on a $10,000 account is about $600. It's a profit, but it's not much. So the chances of you finding something that can give you that many opportunities with that strike rate are going to be very, very rare. So we've got steady growth, but very difficult to maintain because we can't find enough trade opportunities that are that successful. We have high accuracy, which guarantees success, even with a low risk reward ratio. So we are literally running a 1-to-1. You could even run that with a negative risk reward ratio. This doesn't actually allow you to do that. But if you had a 0.8, for example, this would still generate profit for you. Scenario 2, a low win rate and high risk reward. So this would be sort of indicative of something like a trend strategy or a breakout strategy, where a lot of those trend entries will fail and a lot of the breakouts will tend to fail and be false breakouts. So if we use a 40% win rate, but we increase our risk reward to 1.3, what you will see is we generate roughly the same amount of money. So we're generating around about $8,000 in profit. But as you can see, the equity curve is much more jagged. We've got lovely big run-ups, but we've got constant losing streaks, which are then outweighed by market moves which work for us. We have stagnation there where we don't make any money for around about 10 to 12 trades. We have a lovely run-up, a big drawdown, and a big drawdown. But overall, we're making the same amount of money. We're nowhere near as accurate as we were with that 80% strategy that we're never going to find. But finding a strategy with a 40% win rate, very achievable. There's a lot of them out there. The opening range breakout strategy that I trade, for example, has a 40% strike rate, there or thereabouts. So if you can achieve that, or even a lower strike rate of something like 1 to 2, you're still going to generate profit. It's not going to be as much, but it's not going to lose you money. And that's what it's all about, understanding that if you make more than you lose and you lose more often than you win, you are still going to be profitable. You just have to play the averages, use the mathematics and statistics, and let the strategy play out. Scenario 3 is what we call a balanced approach. And this is something that the vast majority of traders are able to achieve, a 55% win rate. So achieving a 55% win rate with a 1 to 2 risk reward ratio is not actually very different. So let's program this one in now as well. 55 with a 1.2. So you can see here we are also generating roughly the same amount of money. So these 3 strategies we've looked at are all generating around about $8,000 each on our 10,000 account, which is an 80% increase. So they are not asking for anything particularly dramatic here. We're not saying we've got to win with the 80% we were, but with these other 2, we're not saying we've got to win tons and tons of trades. We're not saying we've got to use a super tight stop loss and get a massive reward from it. What we're saying is we just want to get in with a realistic stop and make a little bit more money, a 2R or a 3R. And that's all we're looking for, and they will all generate the same return for us. So that strategy there is a good balance of consistency and profitability. And you can see it's kind of the sweet spot for many trading strategies. But if we run simulations on this, if I scroll down, you'll see here we've got a roughly even number of trades. We've got 8 winners there and 7 losers as our biggest streak. And you can see the equity curve play out there. We run another simulation on it, and you can see we've got quite a lot of stagnation at the beginning there. We have more winning trades than losing trades, but we have a period where we just don't actually make any progress. So imagine starting a new strategy like the opening range breakout or some kind of mean reversion strategy using Bollinger Bands, and you take around about 30 trades or 20 trades with it, and you've hardly made any progress. You get beaten down and despondent, and you end up system hopping. So you dump the strategy, you move on to a new one because this one just doesn't work like it said in the textbook or the YouTube video. It does. You're just not letting the random probability play out. So this distribution of 100 trades has been unfortunate for you at the beginning, but you missed that bit because you gave up on the strategy. So it's all about understanding that if you use the mathematics, it will happen. It cannot not happen because of the way that you're placing these trades. The only variable that you have is this. You could have a streak where suddenly that strategy, for some reason, drops because the market conditions change. So let's say we have a mean reversion strategy and the market spends months doing this, going sideways. That mean reversion strategy is going to win a lot because it's just going up and down. If all of a sudden the market conditions change and it turns into a trend, this strategy isn't going to win as many times. It's going to have a lower strike rate. It might drop down to something like 44%. But what happens to your equity curve? You still make profit. It's just you don't make as much. And let's say it goes into a really strong trend and the opportunities dry up. What are you going to do? Not lose money. This is the important lesson. If you have a positive R, regardless of where that strike rate sits, the chances of you destroying your account are virtually zero. And this is where everybody goes wrong. They suddenly go, okay, we've dropped our strike rate down. It's not working as well now. I'm going to up my risk. All of a sudden, you're not getting any further because the mathematics is not going to allow it. You will make more money, but look at the drawdown. It's going to jump up dramatically. So that's basically the balanced approach. So it's something which is very achievable. The opening range breakout strategy that I trade, I use a 1-to-2 risk reward ratio because I know I can achieve a 55% win rate with it. The more you move the risk reward away, the lower that strike rate will generally tend to become. So if you have a strategy where you have a 1-to-2 risk reward ratio and something like a 57% strike rate, if you increase this and go for a larger target, what you'll find is that your win rate will start to drop because the market will have more opportunity to move sideways and come and take out your stop loss before moving up to hit your target. Okay, so the higher you have this, typically the lower that becomes. But as long as you have a balance here, which gives you a positive outcome, you will always make money. Okay, and you can play around with this as much as you like, and you can see what impact it's going to have. The other thing that's incredibly important as a lesson here is understanding losing streaks. So with something like the opening range breakout strategy, which has got somewhere around about a 40 to 50% strike rate. So let's pop that around about 45. You're going to see here, you're going to have a losing streak there of 4 trades. Now you've got a losing streak of 8. Now you've got 7, 5, 5, 6. That's totally normal. Now you can have more than that, but the strike rate, if it drops down to 40%, you can see how suddenly this moves up into higher numbers. It's not actually doing that. That's because I've got you're going to move up into higher numbers basically as that strike rate drops down. And that's basically because obviously your win rate is dropping. So therefore there is more probability of having a run where you continuously lose. And this is very indicative of strategies like breakout strategies where the market goes sideways. And all you're going to do is you're going to get stopped out. And it's the same with trend strategies. With trend strategies, when a trend breakout starts and fails and it goes sideways, the trend strategy is always going to lose. Okay, so trend strategies, breakout strategies, you tend to be looking somewhere between the 33% to the 50% absolute maximum. With mean reversion strategies, you can be looking up to 60, 70%, but you're going to be targeting much smaller rewards on those, something like 1.5. 1.5 with a 60% strike rate is always going to generate you profit. Okay? And that is not hard to achieve at all, is it? So that's your balanced approach. The danger zone, a 40% win rate with a 1-to-1 risk reward. So we're going to look at this as a scenario of what not to do. So 1-to-1 risk reward ratio with a 40% strike rate is always going to lose you money because you're losing 60% of your trades without making more money on the winning ones. Now, I want to show you what happens if you increase your risk in this scenario. So we've got a little peak there where we actually made a little bit of money, but as you can see, it just destroyed us in the end, and we ended up somewhere around about 1,800 down. If we increase our risk, you'll see that the actual total profit dramatically reduces. The more we risk, the more we lose. And this is where everybody tends to go wrong. If you have a strike rate with a 1-to-1 risk-reward ratio and a low strike rate, and you risk more on it, you are going to lose your account. You are going to blow your account. It doesn't matter what you do, the account will disappear. If we move that up to a 50% strike rate, you can see that you are still going to lose money. Okay, and the reason being is when you have these losing streaks, what you're doing is you're reducing your account balance and you are risking the same percentage of a lower account balance, which means the reward is actually smaller. So as you have losing runs, your account balance depletes. And then when you risk the same amount of money to try and recoup those losses, you're actually making less money than you're losing on every trade. So this is a great way to demonstrate why it's so important to risk a small amount of your account. We go back to that break-even scenario again there. Okay. So that is basically account destruction over time. Poor risk reward with low win rate is a guaranteed loss. So the next time you look at a strategy, make sure you understand what the strike rate and the risk reward ratio are. So if you look at a strategy and someone tells you that over the last 6 months, the strike rate is 45%, that sounds great. If the risk reward ratio, however, is 1-to-1, it is going to generate negative alpha, negative profit. Even if you start to risk more money, that will just make you more and more and more loss. Okay? So on the flip side, let's look at a strategy with a 1.5 risk reward ratio and a 45% strike rate and how that generates a positive outcome. Now, this is where it gets interesting with risking specific percentages of your account. So this is using 0.25% risk, absolutely tiny. The risk of ruin on your account here is absolutely zero. You are not going to lose your account because you've got an ever so slight risk reward ratio and a half decent strike rate and very, very, very small risk. If we increase that to 1%, that $300 suddenly becomes $1,200. Nothing else has changed. Our win streaks, our losing streaks, but our maximum drawdown has increased. Okay, so that's gone up to 6% now. If we now increase up to 2% per trade, we are suddenly taking 16% drawdown on our account, and we've made twice as much money. Okay, so every time you move this percentage up, you will find that this will jump up by roughly a multiple of 1%. Obviously, 1% generates us around about 1,000, 2% generates us around about 2, 3% generates us around about 3, 4%, guess what? Round about 4. Yeah, it's exactly the same. Now look at that losing streak here. This is a great example of random distribution of trades. This strategy has a 45% strike rate, meaning that we lose 65 trades out of 100 trades. Okay, so it is 55 trades out of 100 trades. Out of those 100, you can see here we had a big, strong losing streak of 11 at once. Now, if we're losing 55 of those trades, we actually lost 11 of them in one go. Can you imagine having your P&L go from there to there? If you stick with it, that is what's going to happen. But what most people will do is will dump the strategy there because it doesn't work. This is where backtesting is going to help you, and specifically the risk-reward calculator. So just to summarize, understanding drawdowns and streaks, the longest winning losing streak is inevitable. It's going to be there, it's going to change, and this will give you a really good indication. If you program into here roughly what your strategy targets are and roughly what your win rate is on any strategy, it's going to tell you what to expect. So the next time you get 6 losing trades in a row, for example, if you take 1 trade a day, if you have an entire week where it just doesn't work, that's normal. You should be expecting that. You should also be expecting those weeks where every single one of them is a winner. Yeah, they're going to happen. And the drawdown is going to happen on your account as well. And this is something that's very important to understand. Yeah, how risk affects drawdown. If you want to keep your drawdown small, i.e. if you've got a proper valuation that you're doing and you've got to stay within 5% drawdown, you can see that if you've got a 40% strike rate and a 1-to-2 risk reward ratio on your strategy, 1% per trade is too much. You're going to need to risk 0.5% per trade. That's still going to be a little bit too much. But if we run a few simulations, you can see that that time it was 5.38. That time it was 3.94. We passed. That time, 7.6. We failed. And you can keep running these and you'll see how random this is. And it's all based on the winning and losing streaks of the strategy, which is completely random. Okay. So maximum drawdown impact has an impact on your psychology. You have to understand that you're going to have drawdown. There is no strategy out there that does not have drawdown. That does not exist. Okay. You may be able to achieve that over a period of 5 or 10 trades, but it is going to be short-lived. There are no strategies that exist like that. Stop hunting for them. They're not out there. So you're going to have a drawdown, and it is going to impact your psychology. But if you understand what the long-term outcome of your strategy is expected to be, you will be able to withstand those psychological drawdowns much, much better. Positioning, how that matters, 1% versus 5%. We've demonstrated how much impact that has on your account. So it creates much bigger profit, but much, much bigger drawdown. Imagine hitting that 38% drawdown at the very, very start of your trading account. You would be worried very badly, wouldn't you? When all of a sudden you start off with a 10,000 account and all of a sudden you're sitting there on 6,000. You would be wanting to stop that strategy, but it's totally normal if you're risking a ridiculously high amount like that. This is very good for actually calculating proper valuations as well, but I'll cover that in a sec. Profitable strategies have losing periods, we've discussed. Importance of proper position sizing, we've discussed. And psychological preparation for drawdowns, we've discussed. So basically, these are the sort of takeaways from this lesson. There is a takeaway section down there. I'll leave that on the screen for a second, but if you're obviously watching this video on the website, you can read that at your leisure. Another area I want to bring your attention to do with risk reward is on the members section. We have a prop firm calculator as well. I'm not going to go into this in detail because it will be covered in the members lessons, but this prop firm calculator is available for members, and it allows you to plan out your prop evaluation. So it allows you to basically see exactly what the probabilities of passing are with a risk reward ratio. So if you were to risk 1.5% per trade and you are going for a 1.5 reward and you had a 50% strike rate, you can run a simulation over a number of days with a certain number of trades per day and trailing drawdowns if your evaluation has it. And it will tell you whether or not you will pass an evaluation. You can run as many simulations as you like here. So that one failed, that one failed. These aren't great risk reward ratios and everything, and obviously risk, but that one passed, that one passed. And if you wanted to, you can run multiple simulations at once and it will tell you what the probabilities are of passing. So for example, if you went to a prop firm that you took 5 evaluations with, and you used exactly the same strategy on each one, the likelihood is with those particular settings, you would pass 4 and fail 1. Yeah. So this is something else that's available to pro and elite members on the site. You can go and have a play around with this. You can also put in there what your current balance is. If you've got an evaluation underway and if you've been trading it for a few days, and it will basically tell you what you can do to pass an evaluation and how quickly that should happen, based on random distribution of trades. So you are going to get a random distribution of trades. And this is another thing that is very important. The trades per day. For those of you that struggle with over trading, this will really help you, this tool. It shows you what will happen to you if you take too many trades a day. And this is basically to do with revenge trading. You will suddenly start to have, this has got a risk reward that actually works. Because of the risk, but you will suddenly start to lose more evaluations. You've probably been through this. So most traders are targeting a 1 to 2 risk reward ratio there. So it gives you an example of everything that you can do as a trader, basically, to make or lose money, and it shows you visually what is going to happen. So you failed that evaluation. You failed that evaluation. That one you managed to hit, probably more luck than judgment. If you look at it, it very, very nearly hit the drawdown limit there. But you're going to fail most of them if you do it wrong. So this is a great tool to use to give you an idea of how you can plan an evaluation to get funded, okay, which is what most people these days are trying to do. So that's the end of that lesson. The risk reward and prop calculator is there on the left-hand side. come onto the site, have a play around with it. Give yourself lots of different scenarios use your account balance, and put that in, and use lots of scenarios and show yourself what could possibly happen over and over again to your account so that you know what to expect when you're trading with your strategies. Hope that was helpful, and have a play around with it, and good luck in the rest of the course.